Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. I know there's a lot of panic, a lot of worry, a lot of controversy going on around COVID-19 and what to expect. This video is going to explain everything that's going on in the precious metals market. We're going to revert back to the 2008 market crash and use this as an instruction manual how to go along in times like this, in severe exaggerated times. And I use the word exaggerated because even if this doesn't pan out to be as crazy as it may seem, the markets are still heavily exaggerated, heavily influenced, a lot of emotional manipulation going on in these markets, and it's going to drag prices to the extremes, to the high volatility extremes. So with that said, make sure to smash that like button. Make sure you subscribe if you're new, because I do post daily videos. So like I was just saying, a lot of high volatility in these markets. We saw stock market volatility that would push precious metals prices upwards, but right now it looks like every market is getting smashed to the ground. So this virus-related selling panic forces investors to raise cash by selling gold. See, everyone is selling their holdings, their investments, because they're worried the banks are going to close, that they need cash in hand. The history of the 2008 market crash is an instructive for gold investors, and we're going to use that in this video to kind of see what happened and what to do so we don't repeat the same patterns. A gold price low and rebound should soon follow once panic subsides. So they're saying that once this does blow over, markets will recover, and that's important to remember so you do not get involved with panic selling. The gold price has succumbed to recent record-setting across-the-board selling pressure, dropping 12% in just over a week and closing decisively below its 50-day moving average for the first time since December. In this report, we'll discuss the latest technical developments for gold and why, despite a temporary virus-related setback, the metal will likely recover its losses once the latest phase of panic has subsided. So, we will recover. If you think you've lost all your money in precious metals right now, do not be worried. Markets will recover, and they're going to come back stronger than ever, because now we have this recession that's looming. The dollar's been exposed of how weak it really is, and all of that comes along with that as well. We also have the 2020 presidential election and all that as well. So please do not be too scared, because there is a lot of hope, there's a lot of potential. Gold has always been one of the last bastions of strength in the world by serious economic growth related worries and geopolitical problems. But even when gold isn't completely immune to all the too human tendency panic which occurs from time to time, it was clearly evident last week when gold prices plummeted in response to the U.S. stock market's biggest one-day drop since October 1987 crash. So look at that chart. In a mad dash to raise cash, sometimes even the safest of safe haven assets get liquidated. It should also be remembered that during the worst part of the 2008 credit crash, gold was similarly subject to liquidation pressure. So there has been a pattern. Yet the 2008 experience is also instructive in telling us what is likely to be the outcome after the panic related to the COVID-19 virus pandemic eventually subsides. At the depths of the 2008 crash during October-November that year, prices of gold became stabilizing in the S&P 500 index and was still declining. So, this illustration in the following graph shows and compares the daily closing price of the gold trust with the S&P or the SPX back in 2008. So, once the worst part of the credit-related panic began diminishing in autumn of 2008, gold commenced a new bull market, which eventually took prices to all-time highs. See, here we go. In 2011, after the 2008 crash, what happened? We saw $50 silver. We saw record high gold and silver prices. The lesson to be derived from this historical analog is while gold can sometimes be swept up in a broad market selling panic, once a semblance of order and common sense returns to the market, investors typically buy gold as a hedge against any negative economic events that may or may not follow a financial market collapse. So as the recession's looming, this is going to get people thinking about what they really want to invest in. And this is when they're thinking most rationally, and this is when they turn towards gold. I expect gold's performance during the following coronavirus panic to basically follow the template from the 2008 market crash. After some initial weakness, which may last only a few days, the gold price will likely stabilize quickly once there has been a suitable policy response to containing the virus and its economic impacts. In the U.S., investors are panicking right now. In part, they're being barraged by a continual stream of the worst possible news from the mainstream media. But the panic is also partly because the public isn't seeing a suitable response from the U.S. government. That's also true as well. And because we don't know the extent of this is going to go. We don't know how much worse things are going to get. The Federal Reserve has done its part by lowering interest rates, pumping all this money into the economy. But the good news is that the bipartisan fiscal policy response from Washington should eventually help in calming the markets. Already a second stimulus package is being discussed. Once Wall Street's runaway fear has subsided, gold should be among the first major assets to establish a bottom, as was the cause in 2008. After gold has confirmed that a bottom is in place, its intermediate 3 to 6 month direction should be pointed upwards, and investors will likely be worried about the lingering global economic impact from the virus for the months to come, and that's when they buy more gold. So, very, very, very good article. I want to share this other article as well since we still have some time in today's video. Make sure to smash the like button. Let's see if this video can get 100 likes. Well, you guys have been killing it lately with all the likes and the subscriptions. I appreciate it so much. It's so important to stay subscribed to channels like this because I'm busting my butt all day long finding research, finding articles, finding the newest, freshest information to share to you guys and gals so you can be updated and know what's going on in the world of precious metals and how you should be investing, whether you're buying, selling, trading, or holding. I am your channel. This is your guy. So Exter's pyramid implies a potential run to gold. COVID-19 seems to have lit a fuse in the financial markets. A few cracks in the bond market is all that's needed for gold to move higher, and ultimately the gold miners could benefit in a big way. It's March 13th, and its S&P 500 is down 25%. And by the way, this article was written today, but he's referring back then. So the COVID-19 virus is spreading. The odds are that good volatility in the markets will continue in the near term. The S&P 500 rallied today and is back above the critical 200 WMA, the weekly moving average support level. I think this will be retested soon. Is a sell-off event following up the financial crisis that may have been waiting for the 2008, which we just mentioned earlier in this video? Is the coronavirus the pin that will pop everything bubble, which is a lot of people are speculating? This could be the icing on the cake to really show a recession looming, like I made in the video earlier today. So far, this market sell-off has not brought any other financial crisis. No banks, no institutions had failed like what occurred in 2008. So far, all we have is a large sell-off, but that's so far. Is there going to be a second phase of this sell-off that brings another financial crisis? Nobody knows for sure, but if coronavirus continues to spread in Europe and the USA, the odds are certainly increasing for that outcome. So here's Exter's pyramid. This is a pyramid. So the question arises, how well prepared is the global financial system for the next crisis? As a gold investor, you need to be aware of Exter's pyramid. This is pyramid risk, and the gold sits at the bottom as the ultimate safe haven asset. Right above that is cash, followed by short-term bonds. So you could see that this is Exter's pyramid, and it shows gold, then paper money, then treasury bills, then government bonds, and you can see all the way up how the chain goes on. But gold is definitely the smartest. As long as cash and short-term bonds are considered safe assets, then gold is not needed as a hedge. This is why most investors do not hold any gold in their portfolio. However, if the bond market begins to crack, the only place to go for safety is cash and then gold. And then we have a recession looming as the dollar being exposed, which cash might not even be. Moreover, if governments print money like a banshee, even then cash becomes, like I just mentioned, even then cash becomes suspect due to inflation and debt concerns. So it's all leading back to gold. So we have not had an inflation war since the U.S. in the 1980s, although other countries have. Plus, we had not had a global bond fear since 2008 to 2010. The reason why gold increased in value from 2009 to 2011, in my opinion, or in his opinion, was from bonds and currency fears, as investors moved down the pyramid to acquire more asset safety. I call this the gold fear trade, which could easily return if bonds begin to crack. So, gold is the ultimate asset, according to the Exter risk pyramid. However, This asset is only needed when the rest of the pyramid fails or partially fails, which I do not agree with, actually. Gold is a great hedge for many reasons, and there's potential beyond all of this that's even going on with this, but gold is not needed as little demand. Such is the situation we are experiencing at the moment. When I say little demand, I'm referring to the fact that only about 1% of investors hold any gold in their investment portfolio. And most investment advisors consider gold something that only central banks own, which I definitely do not agree with. So, he goes into his gold investment thesis. If you want to carry on, I will link this article, both articles, in the description. But, he's going on. Let's go down to here and then catch his conclusion. So, easiest way to play. So he's talking about ETFs, gold and silver ETFs. The two big gold miner ETFs, GDX and GDXJ, are the easiest ways to take position in gold mining stocks. Now, I prefer physical bullion, like I mentioned on this channel, but I know a lot of you do invest in the stocks or mining stocks. So I'm going to read this part. So they won't outperform many of the mid-tier producers and juniors and the junior miners, but they will likely reduce your risk for exposure. The yearly fees for the ETFs are quite low, considering you're only getting a professionally managed fund. So, catching a falling knife. I doubt that we are at a bottom, considering the volatility in the markets that we are currently experiencing. So, he's saying that there still might be more volatility, and this is his conclusion. So, this is a once-in-a-lifetime investment. You don't get those returns in a sector more than once, unless perhaps you are in it for a lifetime. But for most of us, this is it. This is our opportunity to have massive returns in a short period of time. Of course, you don't have the possibility to have those large returns without extreme high risk. Waiting for the bond maker to crack requires exposure to extreme market volatility. Welcome to the gold miners. So, he's saying, if you do have positions in these right now, the returns could be, astronomical, but that also does incorporate extreme risk as well. Some people have been waiting for a lifetime for this type of stuff. So this really does depend on, glass half full or glass half empty type of perspective and where you're willing to invest. I know like JM Bullion, they're having a 10-day plus waiting period to get your silver and gold shipped out if you want to place orders of the $300 minimum, and it is getting crazier. So it really does depend upon the individual. I am curious to see where these prices are headed in the short term and in the longer term. Is this a repetition of 2008 credit crisis, and are we going to see that $50 silver like we did in 2011, which led up to that? What's going to happen? I definitely think there's a lot of things in play, and silver definitely has a lot of potential. Anyways, I'm going to wrap this video up here. If you did enjoy this video, make sure to smash the like button. Make sure you subscribe if you're new, because I do post daily videos. This is Silver Slayer. I'll see you guys soon. Peace.